Good morning. This meeting of the board is a hybrid physical virtual meeting. While keeping your microphone muted, please join me in the Pledge of Allegiance.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
At this time, I will ask the secretary to the board to read an opening statement on the Government in the Sunshine Act and to address a few technical and protocol items.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Logan will entertain a motion to close the meeting. We have a quorum. The full board is present for this meeting. Chairman Logan, Board Member Hall, and Board Member Smith. Your microphone should normally be muted except for board members and presenters. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you are an FCA or FCA staff member, you are considered a panelist. The outside visitors are considered attendees. Everyone will see the slides as they advance. If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Logan, we're ready to continue when you are.
Thank you. We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
Mr. Chairman, I move to adopt the agenda as published.
I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Mr. Hall?
Aye.
Chairman Logan?
Aye. The motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
And I second that motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall?
Aye.
Mr. Smith?
Aye.
Chairman Logan?
Aye. The motion carries. Please turn to tab 1. The next item on the agenda is the approval of minutes as presented behind tab 1.
Mr. Chairman, I move to approve the minutes for the August 8th, 2024 regular board meeting as presented.
I second the motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Smith?
Aye.
Mr. Hall?
Aye.
Chairman Logan?
Aye. The motion carries. Please turn to tab 2. At this time, I will ask Rebecca Kaiser of ODAE and Matt Alazada of OE to present the quarterly report on economic conditions and system condition and performance. This is an information item.
Hello and good morning, Chairman Logan, Board Member Hall, Board Member Smith. My name is Rebecca Kaiser and I'm an economist with the Office of Data Analytics and Economics. With me is Matt Alizada of the Office of Examination. It's an honor to be here this morning to present to you the quarterly report on economic conditions. Next slide, please. To start with a quick outline of what I'd like to talk about today, I'd like to start with some general macroeconomic conditions before transitioning into the general ag economy, talking about crop prices, crop profitability, as well as how that's affecting livestock profitability. Before finishing out with some quick updates on tree nuts, as well as some comments on farm income, before I pass things over to Matt to talk about system financial conditions. Next slide, please. CPI fell to below 3% for the first time since 2021 recently. Back in July, it came in at 2.9%. Recently in August, it came in at 2.5%. Now that is CPI for all goods. Looking at core CPI, which has food and energy items or commodities and services taken away, those figures came in both months at 3.2%, which is really telling us that food and energy are tempering all over inflation. Really the big driver of this is the decrease in fuel, mainly gasoline and other fuel oil prices, which are down 10% year over year. With this drop in inflation, we are expecting the Federal Reserve next week to cut rates. I think that's the general consensus among people. Now, there may be a consensus that they will drop rates. However, there's no consensus really on how much they will drop rates or how often they will cut rates going forward in their meetings in the next year. One thing to keep in mind is also the upward tick in the unemployment rate recently. So this summer, we've seen it gradually increase, coming in at 4.3% back in July and 4.2% in August. We've also seen the Department of Labor make some revisions in their annual revision process to some of the numbers from 2023 into 2024, saying that they are revising those numbers of job growth down about 28%, or about 818,000 jobs. So I think even though that those numbers kind of point towards a softening in the job market coming a little bit earlier than we were expecting, months ago, it's pointing out that unemployment maybe is a little bit stronger, job market's a little bit weaker than we were initially thinking, last year. In expectation of rate cuts, longer-term mortgage rates are dropping lower. You can see in the bottom part of this graph, the blue line shows about 140 basis point drop from the peak back in October of 2023. Next slide, please. Moving into agriculture and the agricultural economy, as we close out the summer and start to head into the fall and harvest season, we're getting a good picture of what harvest and what these crops are looking like, especially corn and soybeans. On the graph on the left, you can see the 2024 crop conditions as measured by the percent of the crop rated good and excellent. That's the solid line compared to the 5-year averages, which are the dotted lines there. You can see throughout the growing season, we've had about anywhere between a 5 and 8 to 10% increase, or we're about 5 to 8, 10% percentage points above what the seasonal averages usually are. And what this is telling us is that we've had really, really favorable growing conditions there in the Corn Belt and in the Midwest, which is setting us up for record high yields for both corn and soybeans. USDA is predicting corn yields at 183.1 bushel an acre and soybeans at 53.2 bushel an acre. With this, you can see on the graph on the right, we're seeing increased production. We've had some high yield years, some high production years recently. The blue bars on the right are total corn production, and the green bars are total soybean production. And as this production has been pretty high lately, we're also seeing increases in ending stocks. Corn ending stocks are estimated to be about 2.1 billion bushels, which is up from last year. And soybeans ending stocks are estimated to be about 560 million bushel, which is a significant increase from last year. Next slide, please. In this graph, we can pretty plainly see what those good crop conditions and increased stocks are doing to these crop prices. This is the futures price for corn and soybeans, the change since January of 2023. You can see both are down at this point. Corn was down about 33% and soybeans were down 30% from January of 2023. And a big portion of that is coming with the change since the end of May of 2024. At the very far right-hand side of the graph, you can see that decrease kind of accelerate and become steeper as we headed into this growing season and we had these ideal growing conditions. USDA is predicting average farm prices for corn at $4.20 and soybeans at $10.80. Those prices will likely put a lot of farmers very near or even under their break-even prices, which is definitely going to hamper their profitability this year. And while these low prices are detrimental for crop farmers, livestock producers will be able to take advantage of these lower prices for their feed costs. Next slide, please. This graph is showing different change in prices for different feedstuffs. We talked about corn and soybean prices going down, and I wanted to include other feedstuffs that are major ration components as well. All of these have dropped pretty significantly since January of 2023. Alfalfa prices and other hay prices have dropped, and that is mostly a product of the reduced severe drought that we've seen this past year, especially compared to 2022 and then 2023 as well. Grain sorghum, as well as dried distiller grains, which are major components for livestock rations, are down, with dried distiller grains prices down about 50% from January of 2023. It's important to note that feed expenditures are the largest single expenses for livestock producers. This year, USDA is expecting those total expenditures for the sector as a whole to decrease by about $10 billion. Next slide, please. And one example of this is how these lower feed prices are really impacting livestock producers is in the hog sector. Hog profits for farrow to finish operations are back in the black now, with posting profits of about $15 for the past 2 months, but having about 4 months of consecutive positive profits lately here in 2024. And this is up from negative profits or losses of about $50 a head that we saw in July of 2023 as well. Now, to show how these lower feed costs are making a difference here, the farrow to finish operations feed costs in July of 2023 were about $133, and in July of 2024, they're estimated to be about $92, which is a difference $40 per head. And that's really what's making up the bulk of that change in margins there from negative 50 to about positive 15. Now, the other bit is coming from increased hog prices. Feeder hog prices are up about $20 per head from last year's prices, and slaughter hog prices are also above their 5-year averages. While we're seeing some positive profits here for hog producers, there's really not a great way to say that these profits are going to stay around for a while. There's still risk in this industry, especially with prices being not much higher than their averages. If feed costs are driving that profitability, there's a chance that, if we see corn and soybean prices come up, that they will have reduced profitability in the hog sector as well. Next slide, please. Moving on to poultry. Poultry is generally doing better than they were a year ago, and a lot of this is due to the reduction in the numbers of the highly pathogenic avian influenza, or HPAI. We saw a lot of HPAI cases in both chicken and turkey flocks there in 2022 and 2023, and so far it's been pretty quiet on that front here in the fall of 2024. Chicken processor profitability is up to about 35 cents per pound currently, after posting large losses in late 2022 to 2023. Right now, chicken producers are relying on high consumer demand for chicken, as customers are looking for a protein that's a little bit cheaper than the other options out there, especially compared to beef. Turkey, on the other hand, is a different case. Turkey prices are below their 5-year averages and definitely below those high prices we saw in early 2023, which was a function of HPAI numbers. We're also seeing low turkey demand the past couple of years, kind of mostly coming down since COVID. And as we head into the fall, head into the holiday seasons, we're seeing producers are placing fewer poults or baby chick turkeys to reach maturity at that age around the holidays. So in July, they placed 18% fewer poults than the year before, and in August, they placed 10% fewer poults. Now, this is coupled with higher than average frozen whole hen birds in cold storage. So there's not too much risk about there not being enough supply coming into the holidays. Everyone will still hopefully get their turkey. But I think producers are really reacting to the lower prices and limiting the amount of poults they are placing. Next slide, please. As far as cattle go, cow-calf producers are still capturing a lot of returns there with high prices. We're seeing estimated returns for cow-calf producers in 2024 to be around $623 a head, and estimated into 2025 over $700 a head. And a lot of this is to do with low inventory numbers as well as, high calf prices. You see on the top graph on this slide, this is the feeder cattle futures prices going back about 15 years. And I wanted to include this time length to show one full cattle cycle, at least kind of where we're at now, and comparing it to where we were back in 2014, 2015, 2016. The line on the bottom part of this graph shows the percent of heifers on feed as out of total cattle on feed. And this number really gives us a good indication of what kind of herd rebuilding is going on. And as that number is higher, we're seeing that producers are not carrying any heifers over, retaining any heifers to rebuild the herds. Currently, that number is about 39.6%, which is pretty high. As you can see, it's kept up about that high for the past, at least 4 years. But if we look in that shaded gray box, we can see that's when the last time we had an expansionary period of the cattle cycle, when the number of heifers on feed dropped. You can see that in the grain line. And after that, you can see how feeder cattle futures as well as other live cattle prices dropped. Now, at that point, when we started to rebuild the herd at that time, a lot of that was due to alleviation of drought and better weather conditions. At this point, I think producers are still hesitant based on high interest rates to rebuild the herd, as well as general concern about recessions. The good news is with that is people still look like they want to buy beef. Choice beef demand, as measured by the Kansas State Meat Demand Index, is still higher than what we saw in the summer of 2014 and 2015, which is a good sign for beef producers that hopefully we can keep these profits at least higher for this year and next year. Next slide, please. Now, my last slide here, I want to talk a little bit about some tree nut updates and what we're seeing, especially with almonds and pistachios. In the past 15 years, we've seen expansion of tree nut bearing acres, especially in almonds. And in this graph, you can see the top solid lines are the expansion, the growth of bearing acres since 2013. So that's a 10-year change on this graph. And the dotted lines show the change in the prices for both pistachios and almonds in that same time period. So we can see the little jump in prices there in 2013, 2014. After this, producers really started to expand and started to grow more almonds. And you can see on that graph, almond acres are up 57% in that time. Pistachio acres are up 128% in that time. At the same time, prices are down. Almonds are down 49%. Pistachios are down 43%. Now, almond producers in California have had a tough time lately with weather conditions, drought conditions, whether it's, pollination is not great because the blooms were frosted, or if it's drought in the middle of the summer when they're trying to, fill out their fruit. Production has been a little bit lower for almonds lately, and producers have started to kind of maybe switch into other crops. I think it's a good sign that we're seeing fewer non-bearing acres for almonds. Non-bearing acres in 2023 was about 350,000 acres, and that was in 2020, excuse me. And in 2023, we're seeing that number come down to about 189,000 acres. We're also seeing reports of fewer new almond orchards being planted, as well as some other almond orchards being torn out. This is, I think, at least a good sign that producers are reacting to the lower prices in almonds and are not continuing to plant more almond orchards even as prices come down. However, we're seeing that some of these producers are switching into different crops, one of those being pistachios, which are known to be a little bit more drought hardy than almonds. Unfortunately, as we can see on this graph, pistachio acres are up as well as prices are down. Next slide, please. So before I get to answering any questions you may have, I want to summarize and say that farm financials right now are struggling with a lower farm income this year, especially for those crop farmers with the lower prices. We see an upside of that of livestock producers being able to take advantage of this, but there will be possibly an erosion of liquidity for farmers, with USDA estimating that working capital itself will be decreasing about 4.2% from 23 to 24. However, we are coming off of years of high farm income in 21 and 22, which set up farmers pretty well to weather this storm, I think. It's also comforting to see that farm equity is still high. That concludes my presentation, and I am happy to take any questions you may have before I turn things over to Matt.
Thank you, Rebecca. Does the board have any questions of Rebecca on the material presented? Mr. Hall?
I do, Mr. Chairman. Rebecca, I should have asked this when we met on Tuesday, but I'm thinking about feed grains in particular with big production, big carryover stock. Is there a concern over storage capacity and a very wide basis come harvest time?
Thank you for that question. I think that's a concern probably for a lot of farmers. I know a lot of farmers are considering whether to store their crops after harvest, put those in the bin instead of just trying to take what prices there are now. I don't know any specifics about storage capacity. I can definitely get back to you on that. But I know there's also concerns about whether or not we will be able to export out of the Mississippi River with water levels there, which are trending down this season, even though they were very high a couple of months ago. So we'll just have to see how things come into harvest, what producers are thinking, and how, if they're going to ship crops out or if they're going to store them. See if anything else happens, which might drive prices up to allow farmers to sell now.
Thank you, Rebecca. Good job.
Thank you. Mr. Smith, do you have any questions?
Yeah, just one for Rebecca. It's my understanding you have close ties to rural Colorado and agriculture there, and I'm interested in your age group, which would be real typical for young and beginning farmers. What do you think is one of the primary challenges, concerns right now today?
Thank you, because this is something I have dealt with, struggle with, talking with my parents about, whether they're going to retire, and I know so many people are having these same questions, and there's not really a great answer. I think the biggest issues right now are the accessibility of getting into farming, whether that is high land prices or high machinery costs, especially for me as a cattle producer. High costs of animals is pretty limiting in what I can get into, as well as cash rents going up. I think we might be able to see a little bit of that softening, as crop prices come down a little bit. But it's still definitely a struggle for people to get in, whether they're renting the land or whether they're trying to buy land, especially now for crop farmers. If they're not able to make money, if they're losing money, it's going to be even harder for them to be able to, have the numbers to be able to go get a loan that people are going to want to support.
Thank you. Well, fortunately for you, as a beef producer, you're kind of at the top of the food chain right now, right?
Yes.
Yeah. Good.
Yep,
And looks good for the foreseeable near future anyway.
Yes.
Okay. Thank you. An excellent presentation. Thank you, Mr. Chairman.
Thank you. I have no questions, Rebecca. So hearing no further questions from the board, we again thank you for the wonderful presentation. Thank you, Rebecca.
Thank you. I will now turn things over to Matt, who will present on system conditions.
Thank you, Rebecca. Good morning, Chairman Logan, Board Member Smith, Board Member Hall. As Rebecca mentioned, I'm Matt Alizada out of the Denver field office. My part of the presentation today is to go over the system's financial condition as of June 30th, 2024. Overall, the system remained financially sound. Portfolio growth remained relatively modest, with seasonal factors largely influencing loan demand. Earnings remained strong and contributed to increases in net income, which also contributed to the system's growth and capital levels. The system's loan portfolio continues to remain well. Although there has been some increases in credit risk measures, the system's portfolio continues to be satisfactory. Next slide, please. The focus of this first slide is on system growth. And as you can see, total assets grew to $514 billion, or 1.2% year to date. This was a 6% increase over the last 12 months. Gross loans increased to approximately $407 billion, which was 2.1% year to date, or 7.6% over the last 12 months. The chart on the left demonstrates portfolio growth year to date over the last 10 years. Typically, in the first 6 months of the year, system loan growth is fairly modest, with the second half of the year, loan growth increasing. Moving on to the chart to the right, this illustrates loan categories in 4 major areas. These categories represent approximately 95% of the system's total portfolio. Production and intermediate term loans did decline in the first half of the year. Again, this is due to typically seasonal factors as borrowers pay down operating lines. The agribusiness portfolio did grow 5.6%. As the chart demonstrates, loan demand can vary significantly. Price volatility in cash grains can significantly impact loan demand in the grain elevators and food processing supply cooperatives. Moving on to rural infrastructure, this loan demand did slow down, but did grow 3.3% year over year. The power segment of this portfolio is 65% of this portfolio and did grow modestly at 5% over the last 6 months. Next slide, please. This slide focuses on portfolio credit quality. Overall, the system's loan portfolio continued to remain well. As of June 30th, non-performing assets totaled $2.6 billion, which was up modestly from the same period a year ago when it was $2.1 billion. The majority of non-performing assets is comprised of non-accrual loans, loans that were past due, 90 days past due and still accruing, and other property owned. As you can see on the chart on the left, non-performing assets did increase modestly to 0.64% this year. Although this was an increase, the total amount of non-performing assets continues to remain low. If we were to drill down into non-performing assets, the main category there is non-accrual loans, which increased to $2.1 billion. Again, this was a modest increase from the prior year. Non-accrual loans have primarily increased due to some credit risk increasing in the tree fruits, nuts, swine, and certain food processing sectors. Credit stress continues to be elevated in these sectors as profit margins remain under pressure. Overall, most non-accrual volume is concentrated in 3 areas, which is the real estate mortgage portfolio, the intermediate term loan portfolio, and the agribusiness sector. Non-accrual loans that are current equaled 49%, which was a modest decrease from 55% the previous year. If we transition to the chart to the right, this illustrates other credit risk measures that we call loans classified less than acceptable. As you can see in this chart, loans classified less than acceptable has increased modestly for all loan categories for each of the last 3 years. Although there has been an increase, the total amount of loans classified less than acceptable does still remain relatively low at 4.7%. Next slide, please. This slide focuses on system earnings. Overall, the system reported solid financial results in the first 6 months of 2024. As the chart to the left shows, system earnings year-to-date totaled $3.9 billion, up almost 12%, or $417 million from the same period a year ago. Provision for credit losses, which is the red line on the left, did decrease to $159 million from $407 million a year ago. The chart to the right illustrates the change in net income year-to-date. Net interest income, along with lower provision for loan losses, were offset by a modest increase in non-interest expenses. This did attribute to net income increasing by $417 million. The net interest income increased $296 million year over year as continuing loan growth increased average earning assets. Average earning assets for the first 6 months of the year increased to $24 billion, or 5.3% year over year. The net interest spread decreased 11 basis points to 1.86%. With that being said, the net interest margin did remain stable at 2.41%. Provision for credit losses did decline by $248 million compared to the same period a year ago. This was largely due to two factors. The first factor was the system recognized a higher level of specific reserves in the first half of 2023 compared to the first half of 2023 compared to the first half of 2024. And this was due to a limited number of borrowers in stressed agricultural sectors, primarily in the tree fruits, nuts, and swine. Secondly, in the first half of 2024, the system institution recognized some loan loss reversals in the general reserve based on modeled factors in their certain ag sectors, such as tree nuts, fruits, and swine. Again, next slide, please. This slide focuses on earnings. This slide focuses on capital and liquidity. Overall, strong earnings continue to support capital growth. As of June 30th, total capital $76.8 billion, up from $5.7 billion, or 8% year over year. The system's capital to asset ratios did stabilize and increased to 14.9% in the second quarter, up from 14.7% a year ago. As noted on the slide, total regulatory capital levels at all system banks and associations remain sound and continue to be well above regulatory minimums. Bank liquidity also remains strong, with days available liquidity for the four funding banks ranging from 157 days to 213 days, which was above the 90-day minimum. Finally, the system maintains significant risk-bearing capacity as the combination of total capital along with the allowance for credit loss equaled more than 19% of total loans outstanding. Next slide, please. This slide focuses on FCA ratings. For an individual institution, the composite FCA rating represents the overall assessment of the safety and soundness of that institution. The chart provides a snapshot of the composite FCA ratings for all system associations and banks. Overall, in the second quarter, composite FCA rating for all system associations and banks remained favorable and represented a strong financial position. Collectively, about 96% of all system associations and banks have a composite FCA rating of 1 or 2. There were 2 institutions that had a composite FCA rating of 3 or lower, which was 1 less than last year. In total, less than 1% of all system assets were held in institutions of 3 or lower. Next slide, please. The last slide we have focuses on risks we are monitoring. As discussed in the June board meeting, OE anticipates a more difficult operating environment for both system borrowers and system institutions. The USDA in 2024 is projecting net farm income to decrease for a second consecutive year. In certain segments like tree nuts, poultry, and swine, we've already seen signs of some increasing stress due to wholesale prices along with production levels remaining elevated. Like many other ag sectors, these industries are facing higher non-feed expenses, primarily attributed to higher interest rates and the higher cost of labor. Overall, ag producers, particularly grain producers, are seeing tighter margins and profitability pressures. This will affect liquidity levels and financing needs while interest rates are elevated. Lower margins, along with elevated interest rates, could have some significant implications for farmland values in the future. Ultimately, this more challenging environment for borrowers is likely to be reflected in systems credit quality. Fortunately, the system institutions have sufficient liquidity and financial strength to weather this volatile operating environment. That concludes my part of the presentation. Chairman Logan, Board Member Smith, Board Member Hall, Rebecca and I would like to thank you for your time, and we'd be happy to answer any questions you may have.
Thank you, Matt. Thank you very much for that presentation. Does the board have any questions for Matt on the material presented? Mr. Hall?
I don't, Mr. Chairman. Thank you.
Mr. Smith?
Yes, I do have a question, Matt. Going back to page 21 or the charts on page 21, it's what What jumps out is, although the total number of non-performing assets is still relatively low, the trend is up. We jumped up to 0.64 of 1% here this last year, and I go back to June of 2018, it was just shy of a full 1%. I think watching that trend bears watching, and it is good to see that we've seen capital come up slightly this year, so we know the system institutions are concerned, particularly with the 2024. But I think looking ahead, if the 2024 predictions come about, we're going to see a major erosion in liquidity, and I think we'll probably see a major jump in those non-performing assets. Do you ever discuss when we really need to start, I don't want to say paying attention, because hopefully we're paying attention all the time, but when does it become an area of major concern for us? 1%, we were close to 1%, 2018, gradual improvement. Any discussion on that at all within?
Yeah, thank you for those comments and the question. Non-performing assets along with the system's overall credit quality for the institutions is something we're always looking at. We do have first benchmarks for, as you know, for all system institutions that we continue to monitor and evaluate. I can't remember off the top of my head if non-performing assets is one of those categories. I want to say it is, but that's something we're constantly looking at, and something that we look at each quarter as we're evaluating the system institutions' credit quality. Moving forward, as you said, liquidity levels could be an issue, but that's something that we're going to continue to monitor as we continue to do loan reviews and conduct our quarterly oversight at our system institutions.
Okay. Well, I guess it's extremely dry in South America right now. If that happens to come about, it completely change here a year from now. So thank you for your presentation. Thank you, Mr. Chairman.
Thank you.
I have no questions for you, Matt. So hearing no further questions from the board, we again thank you for the presentation today. Please turn to the adjournment tab. There's no further business to bring before the board. I will entertain a motion to adjourn the meeting.
I move we adjourn the meeting.
I second that motion.
The motion has been made and seconded. Is there any further discussion on the matter? Hearing none, the secretary will record the vote on the motion.
Mr. Hall,
Aye.
Mr. Smith,
Aye.
Chairman Logan.
Aye, the motion carries. The meeting is adjourned.